Good afternoon, everybody. Thank you for joining us today as we kick off our 2024 Professional Advisor Speaker Series. I want to extend a very warm welcome to all of you and a special welcome to our speaker, Alex Palabrica of Jeffer Mangels, Butler & Mitchell, LLP. You should have received his bio and outline of his talk earlier today. Before we go any further, I really want to thank Alex for his commitment to do this presentation, and I really know you're going to enjoy it. I had a chance to look at it earlier today. A couple housekeeping items. First, I want to thank our advisory committee who organizes and selects our speakers. This series only comes together because of their commitment to the foundation and this important series, and they've been
a lot of the speakers are from Loeb and Loeb.
I could ask everybody to mute themselves.
That's what they keep saying. I keep writing whatever.
Okay. I just want to thank this committee for all the work they do. It wouldn't come together without them. And this is our 24th or 25th year doing this. I hope many of you were able to also meet Audrey, our new assistant, who'll be working with us on these sessions going forward. And I want to thank and say goodbye to my colleague, Natella Roisman, who's been my partner on these sessions for the past 7 years. Natella is moving on to Children's Hospital Los Angeles. We wish her the best, and I and the royal we will all miss you, Natella. Since the horrible incident of October 7th in Israel, and with just a month until the high holidays, you and your clients might be feeling a need for a Jewish home for your donor advised fund. So come home. We'll make it easy for you, and I promise you'll feel good about supporting our community together. Please take a minute to watch this short video highlighting how we work with clients to help them maximize their philanthropy.
I'm a big supporter of Jewish education because I think that part of a Jewish education is really the way in which you live your life. And charity and philanthropy is a huge component of that. So I think that passing on the value of philanthropy from generation to generation and the good that is created then from there is just very powerful. And I think that with every generation, if done right, it only gets bigger. One of the great things that the Jewish Community Foundation does is they do these great events where it brings together a lot of like-minded philanthropists and exposes them to different things that they're doing or interesting speakers, but really it brings them together just as a cohort of like-minded people. And I think that in and of itself is very powerful. In the same way of leading by example and talking to your kids is contagious, I think being around other people is contagious too, and it kind of continues to push you in that direction. When you're in that umbrella of the Jewish Community Foundation, they're so flexible, they're so helpful, and it becomes very exciting because you're really all working together towards these impactful projects that you feel are really bettering your world.
Function, and we will take questions at the end. And this is being recorded, right? Alex, thank you so much for your patience, and I turn it over to you.
On my phone too?
Well, on your phone is you're connected to Wi-Fi.
Great. I hope everyone can see the slides. Thank you, Steve. Thank you, Audrey. Clients or elderly clients where you're considering some last minute items. It's framed in a way to address an audience, but also for practitioners. It's some items to consider if you have clients who don't have their estate plans ready. They haven't done consolidation of accounts. They don't have some things that you really need to have gathered during the trust administration aspect post-death. So general overview. We go through just probate generally, why having every client needs a general estate plan, why individuals in California especially need an estate plan set up, planning for incapacity, some of the healthcare documents, a checklist of those things if you're nearing death, items that you might not consider when funding the revocable trust, moving bank accounts, stocks and bonds, LLCs, anything that should be titled to help make the administration period easier. Just reviewing designated fiduciaries, consolidating estate plan documents, which as practitioners is something that we can always do to help, if it's possible at that stage, make the administration period easier. Some tax planning ideas for gifts during life, transfers to spouses, using your exemption amount, tax-free gifts, using the annual exemption. Some other checklist items, just reviewing life insurance, retirement plans, and beneficiary designations. And then other items that you can advise clients or you yourself could use to organize your financials and things like bank accounts, digital asset information, etc. So generally, the purpose of why we have estate plans is just to avoid probate. Probate can be both a difficult and time extensive process, but it also involves a significant amount of fees. I've had clients that have come in, and I've had family members that have said, well, my spouse has died, what can you do for me? And well, at that stage, that's kind of not the time to do the estate planning. It's the time prior to that, because there's not much we can do post death, but there's a lot of flexibility we can do before that. And I'm sure, as you know, currently an individual can pass about 13.6 million. It's 27 million for married couples free of federal gift tax in 2024. The amount is reduced by previous taxable lifetime gifts, specific distributions, other than to a spouse or a charity. We don't know what the amount might change to following the election, absent any additional legislation. That amount will be in effect till December 31, 2025, at which time, if there is no extension, and again, it seems uncertain at this time that it may drop to pre-2018 amounts of about 5.5, accounting for inflation per individual. So we've done a lot of talk with our clients at this stage, both about probate, but also about you might want to make, if you have a taxable estate that might not be taxable now due to the higher exemption amount, you may want to talk to your practitioner, you may want to talk to your estate planning attorney if you're over that threshold amount, to do some gifting using the current exemption just before the sunset date. So we've been sending out letters. It's something to consider, especially this year as practitioners get busier next year, especially post-election. I know my December, everyone in my office, our November of next year is going to be incredibly busy. So it's always something to consider now, on top of just the general probate considerations. And some of those items that we've said, we always tell clients a general estate planning, and everyone needs it. It makes the management of your assets upon incapacity or death a lot easier. You have privacy, if you have privacy concerns, additional flexibility that I'm sure everyone knows here with using a trust allows you. But again, it's something you want to plan for now. And especially as someone is getting closer to end of life, there are some things that you can consider especially on in terms of making medical decisions that you'd want to do now rather than at that point where it's too late. So the number one thing we always discuss with clients is that planning for incapacity. So if there isn't a durable power of attorney, something that gives an agent the ability to make gifts, to fund your living trust, to make transfers to access accounts while you're alive, but maybe not in full capacity, that's something to consider. We always have an advanced healthcare directive that's going to be separate from that durable power. It's a separate document that has to do with your healthcare choices. So I always like to have clients, when we are approaching that discussion, who do you want to have those healthcare decisions being made for you by? You might have different individuals, different agents who you want making healthcare decisions as opposed to doing the actual transfer for financials, bank accounts, and things like that. We also do a HIPAA authorization so that person can access healthcare records. And again, a lot of this is just pre-death planning that makes it a lot easier for clients to kind of do the administration and make those healthcare decisions without any restrictions or red tape. So if they have you or clients have an advanced healthcare directive already, they have a power of attorney now, as they get towards end of life, or they have events that are leading to some health issues, it's always a good time to kind of highlight those and review who those agents are. Those people might change. They might have outdated ones. I know we usually like to say every 3 to 4 years is probably the best time to reevaluate your estate plan, but especially those people who are making those decisions for you. It's a good time to kind of get that updated at this point, at least. And if you don't have one, or your clients don't have one, they especially need at least that power of attorney, the healthcare directive, the HIPAA authorization in place if there isn't a full estate plan there already. So while the client has capacity, or as long as there's the power of attorney in place, funding a living trust is probably one of the most important things to make sure that the actual administration is as easy as possible for the trustee. And there's a lot of items. Our office will always do just a general assignment, and the assignment will say, I give everything to the living trust. We can go to the probate court if things are not titled correctly, but it makes it a lot easier on the trustee, on the person who generally the spouse to sort of have everything that's already titled. So some items that people don't always think about: DMV. If there are cars that have not been titled, it's sometimes a difficult process to get that changed over. LLCs, operating agreements, if there are LLC interests, stocks, bonds, it's always a good time to look at the stock ledger, do those assignment documents, have everything retitled in the name of the living trust, so the trustee can then be the one who can make those decisions. Transfer of the personal residence. A lot of the times, clients, or they'll set up their living trust. They think they're done. But if nothing is really transferred to the living trust, it doesn't serve the purpose of keeping you out of the probate process, which is the main goal. So if there isn't a deed, having just a simple deed, it's a non-taxable transfer. Just retitling the name of the client's personal residence or any real property over to the name of the living trust is important now, and something that we always go and double check if they haven't done so already. Banks and brokerage accounts. All liquid assets generally should be transferred to the name of a living trust. And again, if the trust isn't set up at this point, this is the time to do it. But just putting the name on the banking institution, using the name of the trust for title. Safe deposit boxes should be transferred in the same manner. And usually clients, if before the end of life stage, if they're in the habit of doing this, we always recommend any new accounts that are opened should always be opened in the name of the trustee or the co-trustees of the living trust, and maintaining just one personal checking account in the name of the individuals as joint tenants, just with a minimal balance for day-to-day transactions. So at this time too, while they're funding the living trust, same thing with the end of life, or the healthcare documents and the power of attorney. It's always a good time to review the overall estate plan. Like we said, every 3 to 4 years is when we usually will go back to clients and say, this is a good time now to look at your estate plan. If you want to make changes, but especially towards end of life, the designated fiduciaries are always important to review. People move away, you lose contact with family members. You don't necessarily want that same individual who's named as executor or trustee from 5, 6, 7, 10 years ago now to be the one who's appointed as the executor or trustee in charge of your assets at that point. So we typically will do that as part and parcel with going over your healthcare documents, but reviewing any designated fiduciaries and ensuring, while the person has capacity or has an agent that can make those choices, now's a good time to amend that as well. From the practitioner side, clients always want to come and they have a lot of changes to the documents. We'll do amendments, but if possible, it's always good to do an amended and restated trust. It sort of will take all the amendments. We'll have clients that, they'll do 1, 2, 3, 4, 6 amendments to a trust document, but having it amended and restated at this time just to consolidate everything into one document makes it easier, at least on the administration side. So it's one thing to consider that you can't do post-death, but it's something that might come up while you're doing end of life planning if you can consolidate estate plan documents and just make it as an offer to the trustee or to the client or to the individual at that time. It's not as important, I would say, if you have a spouse that's acting as co-trustee, but again, it's part of reviewing the fiduciaries. If it's a corporate trustee, for example, who might be taking over for a single individual, a family friend, that's something that we like to offer at that time, is to sort of review the changes you made to your estate plan up to that point, and then do a holistic review, and then maybe amend and restate so that there's one single updated document. So especially for clients who are sort of end of life or are thinking of ways to maximize the tax planning or the estate planning they can do prior to death, using their exemption amount, making during life tax-free gifts up to the annual exemption amount. There's other considerations that could be made, transfers to spouses. If a client or you yourself have assets that have highly depreciated, they've gone down in value, maybe you don't want that step up that will occur on death in basis to fair market value. That could always be transferred to spouses, subject to a certain time period. But it really is part and parcel of coming into your practitioner, to your estate planner, and looking at your assets and doing a holistic review. If there are things that you can gift to your spouse to keep it out of your estate so that there is not the step up. And then on the other side, you might have assets where you do want the step up in basis because transfers to the spouses are exempt. You might want to have assets that have highly appreciated to go back to the person who is having the health issues, who is towards end of life. So as long as they're in that person's estate for a year or so, that's usually fine. But it's a consideration we like to flag at this time, is that there are some additional asset transfers that can be done, just maximizing the annual exemption amount for gifts to grandchildren, children, things like funding 529 plans, healthcare need, trust for healthcare needs, trust for educational needs. Those are all things that they might not have considered previously, but now as you get towards an end of life, what can you do at least to maximize that amount before you hit the point that it's too late? Charitable gifts are another thing we like to take a look at with someone who's nearing end of life. A lot of clients, they might want to make that charitable bequest now. There's a few benefits. You'll see the deduction on your final income tax return. You'll also get to see the benefit depending on the time that is left, or the health issues the client's experiencing. They might get to see that actual benefit take place in real life with the charitable group now. But one thing we always like to consider is if someone wants, what they would like to do a charitable gift that is otherwise in their estate plans, otherwise in their living trust, make sure that their attorney reviews the will or the living trust to ensure that the gift doesn't happen twice. We never want to have, someone make the gift during life, the estate plan documents are not updated, so now there's still the bequest that's kind of hanging there, that will happen just pursuant to the terms of the trust documents. Sometimes clients or individuals, they'll also have pledge agreements, contractual obligation with the charity to make some sort of cash amount, some donation. It's a good time when clients are getting towards end of life to also sort of review those pledges. They might want to have some change to how they're funded. I put one example, just that you might want to have funds that were directed to a charity specifically come from some life insurance policy to cover the cash pledge. If there was a specific piece of art that was meant to be donated, sometimes that's not always in the client's possession at that point. They want to at least consider reaching out to the charity to see if that it could be funded with a separate piece of art or some other type of consideration. So just going over the charitable donations that are in the existing estate plan, whether or not they'd like to be funded now, and then just reviewing those pledge agreements to make sure that everything sort of aligns with the client's intent at this point is what we like to highlight. Another consideration, assuming that you have a living trust set up or another type of grantor trust, is that you might want to swap assets. And here I'm mainly considering something like an intentionally defective grantor trust. If you have assets that are low basis, you might want to swap those in for some assets that have higher, or take higher basis assets with a lot of appreciation and swap those for low basis assets from a grantor trust, just so that once they're in the client's estate, they will get that full step up. And that's something that an estate planning attorney will often help you decide, because there is a lot that goes into the timing consideration of what assets should be swapped. The timing and the value is something to consider. You never want to have, assets that have depreciated or gone down in value inadvertently swapped for assets that could have gotten a step up in basis just due to the client's death on transfer. So again, this is one thing that we like to do as part of this review of the estate planning, the 11th hour. But it really comes part and parcel with kind of an overall review of a client's estate plan at this point when they come speak with us. A lot of the planning can be done on the front end, but these are just some of the high level issues that if they haven't considered them up until this point, they're things to consider now, at least while they have capacity or they have that agent in place to sort of make those decisions. So during our meetings with clients on trust administration, we usually like to have this done on the front end, but it's not something people always consider. As a client is getting elite or has health issues or is experiencing sort of end of life planning considerations, we like to review existing life insurance policies, retirement plans, beneficiary designations. If a policy is lapsed, the client or their agent really should contact that insurance company immediately to make sure that they're current. And then you also want to make sure that the policies are at least having the living trust named as both a beneficiary and an owner. Having the beneficiary as an owner of the life insurance plan allows the administration to continue, post-death. The trustee can continue to operate the policy, make payments without any disruption that would otherwise be a really difficult process to go through post-death for the client. And it's the same thing for 401ks, IRA accounts, or other qualified retirement accounts. We also like to say if your beneficiary designations haven't been updated, we discuss with clients, well, at least with retirement plans, often they'll go outside of your living trust. You'll name your children, you'll name your spouse as the beneficiaries, making sure that those are all updated and are documented just on your online portal. It's something that clients don't always consider, but it's something that should at this point be a high ticket item for review and making sure that it's aligned with the client with their intent before death. So this is sort of the same theme as previously, just the organization of accounts. Bank accounts, our office will often do what's called a digital asset authorization. It gives an agent similar to the power of attorney the authority to access third-party social media accounts, email, things that you'd want someone to access, but it can be difficult to do working with a third-party company, email accounts. Because it is our document does give that agent the authority to sort of reach out and coordinate with any third-party provider. It's better to still have passwords and not in a PDF or a digital file, but an actual printout of just here's all streaming accounts, Here's email accounts and the related passwords. Having that all in one document located, it makes it much easier for the agent to then take that, access the account, make any transfers, any changes that might be needed. Like I said, you can always go to the third party with a digital asset authorization and try to have those accounts done. But it will be a lot easier of a process if the client has this all done previously. We often see that this is not something that's done, and we work with the trustee or the surviving spouse to make sure that the accounts are handled the way that the client had intended. But if everything is done in one centralized location, it makes the process a lot easier during the administration period. So those are just the high level issues that I had sort of wanted to highlight for what we talk about with clients. There are some others that will often come up. Making sure that LLC operating agreements, partnership agreements, those are all, like I said, all transfer, all retitled in the name of the living trust. Certain gifting is another thing that we like to consider. I talked previously on the last slide of making tax-free gifts using the annual exemption amount. It's not just the annual exemption amount. It's also making potentially taxable gifts. The effective tax rate, because it's exclusive of the tax paid, could be lower if the gift is made during life, rather than have it done through the general estate plan. So we always, again, talk with clients, see if there's gifting that can be done now during life that might not be wanted to be done during the as part of the estate administration. But again, it's working with your practitioner, working with your estate planning attorney to sort of make sure that the estate plan documents then conform with any transfers that are done during life, just to avoid any sort of duplicative transfer that might happen at that point. Gifts from spouses. Because there is no tax on a transfer between spouses, looking for any depreciable assets that might be afforded a step up in basis. If you transfer assets from the spouse to the client, or from the client to the spouse, going from client to spouse, we always look for items that you might have, or you might not want that step up there. Like you might want to take it out of their estate at that point. So the gifting during life, again, it's something we always look at least at this time for clients who are sort of nearing end of life, if there are some big ticket items there that we can kind of review for them. So you also might want to terminate old family partnerships and trusts. Going back to just reviewing fiduciaries. Oftentimes clients will, they'll be trustees on older trusts that would serve no purpose, that the funding has all been done. If they can exercise at that point a resignation document to step down from their role as trustee at that point, that's always something that we like to consider to make the administration easier for those existing trusts. Terminating old partnerships, it will help eliminate any unneeded entities and organize the estate, just to consolidate everything and make the administration period easier. So the client also has to just sort of weigh those decisions on whether or not to terminate a partnership, to terminate an existing trust. On one hand, any trust that the client did create has to be disclosed on their tax return, which might cast a spotlight on assets for the IRS. But on the other hand, terminating a trust, if it forfeits, it also will forfeit any creditor protection or other benefits that the trust structure allows for. But the main benefit being here that you have an administrative ease for the person who's left. So terminating any lease agreements. This kind of goes back to just an overall review of a client's assets. If they can terminate any lease between themselves, any trusts or any other entities that were created during life, that the IRS can always argue that the lease wasn't being paid at fair market value, resulting in a gift tax or an estate tax inclusion. So having those paid off now, or a lease canceled, can make the administration and then the reporting obligations much easier for the surviving spouse or the remaining trustee. The same thing goes with any existing promissory notes. If the client had sold assets to an IJIT or to another type of grantor or trust, they may consider paying off those notes prior to death. Paying off the note would avoid that same argument by the IRS that the loan transaction constituted sort of a retained interest. If the IRS was successful in making that argument, then I'm sure, as some practitioners know, then all the property would be included in the client's estate. Alternatively, the IRS could also argue that a deemed sale occurred just before the grantor or the client's death, which would have the client or the terminally ill individual recognizing gain to the extent of the balance of the promissory note. So whether or not that should be done, again, it's a discussion that we like to have with the client at this time. It weakens a lot of the IRS arguments to have these notes paid off, that the grantor trust had that retained interest such that the assets would be brought in back for estate planning purposes. But it's one of those items that is often hanging and that we like to flag during end of life considerations. So I have also just a few other big ticket checklist items that we like to go over with clients. A lot of them were named here. It was planning for incapacity. Back on my overview. Planning for incapacity, funding that revocable trust, making tax-free gifts if they're possible, making charitable gifts during life, using your gift tax exemption if it's possible, making use of the annual gift tax exemption amount, substituting any of those low basis trust assets, and transferring any of the depreciable assets to the spouse. But a lot of this is a consideration that the client themselves might not be able to sort of pinpoint as an issue as they get closer to really having to do the trust administration portion of the estate planning process. So planning for incapacity, having the durable power of attorney, it's something that a lot of our clients, we often will be approached. I know I need an estate plan. The estate plan has never been set up. So at a bare minimum, those items, the healthcare powers, the HIPAA authorization, are all things that we like to see in place, but also getting a full estate plan set up at that time so that these other planning considerations can be accounted for. If they do choose to revisit designated fiduciaries, getting contact information from those persons so that they're aware of their role going forward. Ideally, if it is a spouse, that they'll take over as that co-trustee, that they're aware of their responsibilities and sort of the post-death, or during trust administration items that typically need to be handled. Some other items like the closing of outdated trusts or older family office planning entities is not always something that needs to be considered, but it is if it's we've been working with a client for a while and it's part of something that they should consider, that we like to bring up. If they would like to transfer sale of homes, something we always consider too is just the property tax reassessment due to Prop 19. If the spouse intends to live in the house, generally not an issue, but where we see it typically is, we'll have clients where, they own a property, it's going to their children. The children have decided, well, I don't want to live in the house. Because of Prop 19, they no longer get the parent-child exclusion if they're not going to live in the house as their primary residence. So even though there is the step up, in California, a lot of the times we'll have clients where they're not able to sort of meet the ongoing expense of a property tax reassessment. I had a client recently where, they bought a house 45 years ago in Echo Park. They pay $1,000 a year in property tax, which is an incredible, as someone who just bought a house at a much higher property tax base, that is was great to see. And they were older. They were sort of thinking of some of these estate planning considerations. And, rather than they really wanted to keep the property in the family, right? They didn't want to have the house sold. It was, where their kids grew up. They wanted to make it a rental property. So we have some planning considerations where they were able to get out, or at least have a lower portion of the property reassessed for property tax purposes. So that was one planning option. That it's a multi-year process to do the applicable transfers. But in their case, where they had a lot of time, they were elderly, but they weren't sort of near end of life, where they wanted to really keep that asset in the family for family wealth building purposes, that it was something they could consider now, versus if it had been transferred, it would gone outright to kids. They would have to step up in basis. More likely than not, that would be the time when they really would have just sold the house, because they wouldn't have been able to pay the ongoing property tax expenses. So we always look at whether or not that's an option, but also to make sure that the property has been titled in the name of the trust, to avoid probate. Any other real property besides the primary residence, ensuring the transfer, again, because there is no transfer to your revocable living trust. There's no reassessment. There's no property tax due. Those are usually the big things that we look for. Some other clients might also have private foundations. That's besides the charitable pledge agreements, besides the charitable donations that might be in the estate planning documents. Just making sure that those organizational documents, that there is a succession plan in place. That's sort of something that's left by the wayside, that we'll see that the organizational documents for, a private foundation don't account for the client, or for the individual who's typically in charge of operating the foundation. If there's no succession plan, then it's a lot more of an administrative burden to kind of go through and make sure that everything is structured properly. So disposition of digital assets. Again, I think the big item there is just really ensuring that the client keeps, or any individual just keeps, one solid place for every password. We often see it come up on just the practical side with streaming accounts. It's an ongoing charge. The client can't get access. They didn't have the email associated with it. They didn't have the password. So that's something that, it can go by the wayside in the overall planning process. But if the client had sort of kept just that one-page document with, respective accounts, passwords associated with it, you have a digital asset authorization for your agent to sort of access or dispose of those assets. It makes the administration process a lot easier, and we have a lot fewer issues going forward. The last item too, that kind of goes with planning for incapacity, is just what the client or what the individual might want to do with disposition of remains. The Advanced Healthcare Directive will give an agent like full authority to make certain or circumscribed authority over healthcare for someone who is incapacitated. But often clients have wishes that have to do with disposition, cremation, any genetic material, or or disposition of that genetic material. We have separate documents for that as well, but it's not something that's always considered. So we've done separate directions for cremation, for example, where a client might want to have that directly spelled out for whoever's handling their estate, that they would like to have their remains cremated. So it's something to consider at this point when they do have capacity, or if they have an agent that can sort of help facilitate that process. But just flagging it as an item to consider along with their healthcare decision. So yeah, I think in some really planning for a capacity is just going through all of your relevant documents, making sure that you have an agent, and making sure those agents are the people that you would like to make certain healthcare decisions, make decisions for you in case you're incapacitated, having that durable power of attorney in place since it will stay in effect post-death, so that even if some of these transfers aren't handled, like a charitable gift, for example, that agent can at least help facilitate making the transfer. So it really is what we like to say is if you get towards the end of life of a client and that's flagged to you, hopefully they have an entire estate plan that's already been set up. But if not, then these are some of the things that we like to flag from a high level to consider is just can they make use of their assets that they have? What's the basis? Is there a good way to sort of transfer those assets between a spouse? Maybe give some of the assets to children, grandchildren. Can they be swapped in and out of a defective grantor trust to make use of the lower basis assets that are in there already when you do get the eventual step up? And then really the overall idea is just make it easier from an administrative standpoint. If we can have everything set in place now, the trust administration, it ends up being a lot smoother if the powers for the agent are there. Everyone agreed, the client agreed with the designated agents that are put in place. Their charitable wishes are already lined out. Their healthcare wishes are already outlined. And again, these are all sort of things that when I've had clients come post, I've had a parent who died. What can I do? I know that they sort of wanted things to be done this certain way. It's a lot harder to make that happen, if at all, besides the difficulties of going through probate, which I'm sure as some of you know, probate is the fees are set by statute. So it can be both a complicated process and a process that is expensive. So having some of this done, even though the cost might seem a lot sometimes to clients or individuals on the front end, it does end up saving a lot of both fees and some headaches for the person who's then going to administrate the trust or run the estate administration on the back end. So again, these are some of the high level issues that we like to consider, but planning for incapacity, making sure that the living trust is funded, all the assets are titled appropriately, if there are opportunities for gifting, and then going through those asset considerations are all things that we like to highlight. So that's basically our sort of checklist, but I'm happy to take any questions on any specifics that come up from there from anyone from the group.
Thank you, Alex. I really appreciate the presentation. I do have a few questions, and thank you for taking the time to do this. I'll get through as many as we can before 1 o'clock. The first one is talking about what happens to donor advised funds when someone passes. Do you have to specify who takes over the management of the DAF, or can they continue contributing to it or retitle it? I'll just speak for the Jewish Community Foundation. If you have a donor advised fund here, we allow successors to the fund. So you can name a child, an advisor, or a number of charities. I can't speak to what banks or other community foundations do, but Alex, you may want to.
Yeah, that's typical from what our experience as well is that the donor advised fund will allow the client to go in and name a successor. It's kind of the same idea with if you had a private foundation, making sure that those organizational documents account for a succession plan. So it's something we highlight if there is a donor advised fund that's named in the trust. Sometimes they might want to have a different individual named on that account. But it's something we like to flag and to contact the administrator of that fund to make sure that they have everything they need for a succession plan so that there isn't any interruption or any question about during the general estate administration process of who's running what or who's making the decisions with the funds that are there.
I'm just going to make a plug for the Jewish Community Foundation for a minute on this point. We work with many, many clients who want charitable donations made at the end of their life, and they can name a donor advised fund, the recipient of the charitable portion, and have an agreement with us about how those funds will be distributed. And if they decide they like a different charity next year than they like this year, they don't have to change the trust. They just change the agreement in the donor advised fund. And it saves them a little bit of time and money with their attorney. Not that the attorneys are not doing good work. It saves them.
Sure.
It's a lot easier to change it with us than it is to change your trust. So it's just a little plug for that. Several other questions. Alex, you mentioned having partnership agreements and the name of the trust. What about S corps? Because tax law requires S corp owners to be real people. Do you have advice for those who may have a family business which is structured as an S corp?
Yeah, so if it's your living trust, a living trust, so let's say it's a co-trustee with the client who's near end of life and the spouse, now the spouse takes over, it's still their revocable living trust. Let's assume that none of the S corp shares went outside of that trust. That's fine, but it's a permissible S corporation shareholder, but we like to typically make sure that we review what trust is going to be holding what the S corporation shares so that it complies without invalidating the S corp election. You might need to make an electing small business trust election, a qualified subchapter S trust election. Both of those would allow, let's say it's a single individual, they die. Now you're in it's an administrative trust, it's its own tax ID. You'd have to make that election, and it's something that we like to flag now so that you have some planning guidelines in there. Often the trust will allow the trustee to make that election and then just put the S corporation on notice that it might need in its books and records to change that along with any stock assignments to the proper shareholder. But going forward, you can still have S corporations being owned by these certain irrevocable or like their own tax ID trusts. It's just that you want to make sure that it has the proper election in place as well. If that election can't be made, then that's again something that you want to flag now while there is capacity before it's almost too late and you're sort of doing the planning on the back end.
Here's another question. It says, my child is my sole beneficiary. Does it make sense to name that person as a co-trustee in the future so they can act if I become impaired?
You can name your child. Often though, we'll have some other individual. It depends on what the age of the child is too. If you want to have a little bit more specific drafting in your estate plan, the child could become, if there's a trust being named for the child, even if they are the sole beneficiary, at a certain age, maybe they become co-trustee. Maybe at a certain age, they become co-trustee with that other individual that you name. But typically, even if they are the sole beneficiary, we'll have a separate individual first that helps with the estate administration. It's a specific question that we can always help with, but it might depend really on the age of the child. But if there's a separate trust being named for the child, but in the overall administration aspect, if you have your spouse there, then we would have them typically as the sole trustee, administering it out to the child as the sole beneficiary.
Okay. This is back to the family trying to keep their home. Is there a process for keeping a low property tax basis for a family home if the children don't want to live in it?
Yeah, and it's a multi-year process. It's something we've done to address Prop 19. It has to do with just transferring, in generally from a high level, smaller portions of an LLC interest prior to a change in control. It's something that it is a multi-year process just because of step transaction and a few other tax considerations. But this is why it kind of comes up in this presentation, right? It's 11th hour estate planning, but sometimes, you might have clients where parents are 70, they're in good health. That would be the time to start reaching out to your estate planner, reaching out to an office to consider those during life transfers to address the property tax consideration. But it's less so something that you would end up doing post-death. So because you get the step up in basis, and that's sort of what you would lose is you may lose a portion of the step up in basis, but you're transferring what should become a rental property to your children to do family wealth building, essentially. If the children want to sell the house, it's a terrible idea. It's not something you want to go forward with. But if the idea is you really want to keep the property in the house, or sorry, in the family for future wealth building purposes, and there is enough time, you're not sort of on your deathbed making that consideration, but you're thinking of it now. That's something like our office can help with, your estate planning attorney can help with. There are strategies to address that, but it's a good thing to think of now, almost prior to the 11th hour for estate planning, if that's something you'd like to consider.
This is maybe a chance to do a plug for the work that you do, but there's an explosion of online services for estate planning. I mean, more and more companies out there. Are there things that people should be thinking about specifically when they're using those? Like we have a lot of younger people using those kind of services. Anything that they should be thinking about if they're doing that?
Yeah, I would say so. My practice, our office, we work with all ranges of clients. I do income tax planning and estate planning. So we really help people with family businesses get ready to sell the business. So that's everything from, the pre-sale stage to setting up their estate plan, all the way through the transaction to then doing things like getting you out of California, doing some post-sale structuring. Uh, Obviously, the cost is a lot easier when you're using something like LegalZoom. If you have a very basic estate plan, I would say there's always some ambiguity in some of those documents. The cost for a probate procedure, and they're not all inclusive. Our office, at least, we take care of every ancillary document. It's the healthcare powers, it's the digital asset authorization, it's the will that pours over, it's a pour over will, so everything goes into your living trust. Everything is maintained in our off-site fireproof safe. So you kind of walk away with knowing that you have a comprehensive estate plan that does exactly what you want. But that's not always the case, I think, with some of the third-party companies that are giving out these form documents. And we've seen ambiguity, and we've seen, well, that's not really what dad intended when he did this LegalZoom trust. But because probate fees are set by statute, a state of 3 to 4 million, you could see, and those fees are based off the net estate value. One, it makes the transfers difficult, but fees could run up to 150,000 plus just due to the way the statute is set. So we always say yes. It is easier in theory to sort of just get the form documents from something like a LegalZoom, but the minimal cost to come in, have the assurance that that everything is done the way you want it done. I would say again, some people will always go forward with just using what's easier, but especially if you have any family businesses, if you have property considerations that you'd like to account for, if you really want to make sure that that your estate plan is handled the way that you would like it done, and that it aligns with the discussions you had with your attorney, it's good to go in. I think the cost, the balance of the cost is much more worth it than going through the estate planning process. And when someone does die on that post-death during the trust administration process, you have an attorney, you have an office to go to, you have a process that you're kind of not left out in the dark so much with the form documents to figure a lot of it out on your own, almost the same way you would with a probate procedure. So yeah, I think there are people who might say it's easier just to go forward and just use the generalist from LegalZoom, use whatever form we get. But I think if you want to be confident that your estate plan is going to align with your wishes and the discussions you had with the real person, then it's good, and it definitely outweighs the cost of having to go to probate.
Thank you, Alex. I have time for one more question. And if we don't, when we wrap up, if you have additional questions, I sent you Alex's contact information, so please reach out to him directly. I'm sure he'd be happy to help you. This is the last question, and it's probably a resource issue. People have older clients, no children, they own their home, they have pensions, they have assets, but nobody, and this happens more and more in LA, I feel like they don't have anybody to take care of them if they become ill or incapacitated. any recommendations of resources for managing affairs?
Yeah, it depends. I think for higher net worth clients, we have a wide range of corporate trustees that we will put in, and they have a great bank of resources to kind of help with incapacity. They'll have options for those healthcare decisions. That comes up a lot more, and I've had clients recently where they have no family in the area. Where do they go to? So I can look for some more specific references that I can reach out and circulate. But if you do have the option of wanting to put in a corporate trustee, if you're a single individual, especially, and you're figuring, well, who's going to handle everything when I'm gone, or just putting in your spouse as a co-trustee with that corporate trustee to make the administration sort of have a partner to go through the process with. And I think in that case too, working with something like our office or another estate planner rather than using the legal Zoom forms is super important, because they can act as a resource. They can sort of help you through that process. There's a lot more hand holding they can do rather than being left out in the dark. So anything below a certain net worth, I can certainly find some references and circulate for everything to go to the group here. But having just a point of contact and working with an actual attorney, I think is especially important in that case.
Thank you, Alex. I would love that resource because it comes up a lot for us, people who are, single, no children. We recommend corporate trustees, but always happy to have a new list of people. Thank you. Thank you for your time. Thank you for taking the time to answer the questions. I just want to remind people that we have another event coming up, the second in our series, October 29th. For those of you that are celebrating the Jewish New Year next month, I want to wish you a happy, healthy, and joyous New Year. If we can be of any service to you and your clients going into year end, they're interested in a donor advised fund, an endowment, a gift planning strategy, please contact us. We're here to help you. I hope to see you all soon in person. These are getting harder and harder on Zoom, but hopefully we'll get back to in person. And Alex, thank you again for your presentation. I look forward to seeing you all in October. Thank you.
Thanks, everyone.